Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the market closing show where we are going to be helping you understand the entire day's wrap up. Of course, we will also find out what exactly is the current trend looking like, what are the sectors and the stocks that are in focus, and of course we'll help you with a market strategy with our top market expert also joining in. Let's quickly look at the markets. They have actually slipped to the low point yet again. So we are inching lower, closer to 25,516 now. 81 points of a loss is what we've already seen. Last couple of sessions have already seen a lot of selling pressure build up, and this day was no different. We have seen right from the word go that the markets continued to slip in trade. Now, of course, when we do see some of the sectors, in fact, all the sectors today, barring just IT and auto, they are all down in trade, and led by, of course, media, metal stocks, real estate. Those are the top losing sectors in this point. Although on the earnings front, on the stock specific news front, there are a lot of stocks on the Nifty that are still hovering higher. You have Asian Paints, that's among the top movers today, about 4.5% higher now at 2600 levels. Reliance Industries, Mahindra & Mahindra, Tata Consultancy Services, even Indigo post earnings is doing well in trade. But what's declined clearly is Grasim post earnings, Hindalco, Adani Enterprises post earnings, Power Grid, Eternal and Eicher Motors. These are all the stocks that have lost some ground in trade. But let's welcome Mr. G Chokkalingam from Equinomics Research joining in on the program to share with us his views on the markets. Warm welcome to you, Mr. Chokkalingam. Good to have you with us. What's your fresh take on the markets right now? How have you been assessing the last couple of weeks that have panned out to be quite lackluster in trade? Of course, reflective of the lacking strength of the markets at higher levels, higher selling pressure being witnessed on a day-to-day basis. How have you assessed all of that? What do you think is the key reason? And what is the market clearly waiting for to see the next leg up?
Yeah, very interesting question. I would be very happy to answer this. And it's my great pleasure to come on your channel.
Thank you.
Last 1 month, I have been advocating a cautious approach in small and mid-cap space. Fundamentals remain strong, but the biggest problem, which I have seen from 1992 boom in the primary market, that whenever there is a massive boom in the primary market, it finds its own, end of the bull cycle, and that starts from severe correction in the secondary market. That is, mostly the public issues are concentrated in the small and mid cap. So when the bull market hits a peak in the primary market, the maximum liquidity is chucked out of the even secondary market for supporting the public issues, and then comes massive correction, valuation correction in the small and mid cap. That again in turn leads to problem for primary market. This is what invariably happened from 1992-93 consistently. So already more than 1.3 lakh crore is mobilized through public issues, and a lot of promoters have sold their own shares in the last 2 years, and a lot of recently listed companies are going to see expiry of a lock-in period, and so therefore the pressure on small and mid cap is obvious. Unfortunately, for next 2 months, probably by end of this current calendar year, we would have to prepare our mindset to bear the pain in the small and mid cap. It's solely on account of liquidity constraint. And very interestingly, the universe of small and mid cap stocks also expanded vastly in the last 3 years because of the primary market bull run and also the bull run in the SME market segment. So now there is a limited liquidity, but there is a severe competition for that liquidity among huge number of small and mid cap stocks, and then among huge number of themes which have played out successfully, including digital theme. So the pain is going to be there. When it will bottom out and start rising, I firmly believe, as far as liquidity is concerned, it is a zero-sum game between primary market and secondary market. So only when primary market starts correcting and the issues find it difficult to mobilize the kind of money they are mobilizing at the current valuation, then we can see the revival of small and mid caps. Of course, selective individual stocks would do well in small and mid cap. That has been the case all the time, even in the worst market condition. That would depend upon individual stock stories, in terms of mergers and acquisition or solid growth story or unlocking potential, which really materializes. So these are the individual stories which will help us, to retain the equity wealth in the small and mid cap in the short term. Otherwise, it's going to be a very painful one.
Okay, got that. Mr. Chokkalingam, let's start off by understanding the current flavor in the earnings from you as well. We are already in the fag end, last 1 week of earnings only remaining. What have you assessed so far? Has anything stood out for you as outperformance or staring at you as a red flag as underperformance in this quarter? What would you like to highlight to all our viewers?
So far, it is in line with expectation. That is, the FMCG IT, which used to be defensive and strong growth stories in a difficult time, they are continue to struggle. They are struggling. They are not able to come back to strong double-digit, profit growth. So I would say that it is better, be very, very selective or even avoid these two segments in the short term. Like IT sector, large companies are expected to grow only at the rate of 2 to 4% in dollar term, their revenues. FMCG also, there are a lot of structural changes which is hitting them in terms of, digital business also taking away, regional brands taking away their market share. So the second, the trend which is visible is that the banking industry story that remains very strong. In even 3-4 years ago, the public sector banks used to have a net NPA of 4 to even 7-8%. So now most of the PSU banks, their net NPA has come down less than 1%. It's hovering around 0.5%. And their CASA deposit, low cost deposit also remain intact. And the industry tailwind is also there. The top line, the industry credit growth is still in double digit. So this banking sector, particularly the PSU banking segment, would be the most bankable sector even in the short to long term. So because the interest rate cycle is going to continue to reverse, that may give pain in the form of NIM pressure, but ultimately medium term, there will be realignment of cost for deposits and yield on advances. That's what happened in the last 2-3 decades, and the demand for loan will increase, and therefore the banking sector is on the top of the radar, and followed by automobiles, particularly the large passenger car manufacturers. That is going to be quite strong. Even selective two-wheeler players would do well. So also even the cement plays, the prices have recovered and they are doing relatively better. So this is what getting reflected in the earnings also. So these are the 3-4 observations I could share with the viewers.
Okay, got that. Before speaking about the specifics on certain, earnings as well, let's also address what's the buzz on D Street. And right now, it's all about the IPOs and the primary market space, and how every day we are looking at some of the other IPO that's opening. Meanwhile, viewers, don't lose the sight of Nifty. It slipped below 25,500 and now 100 points lower. So we are at the low point of the day. So we'll continue to look at how things turn up. But Mr. Chokkalingam, this entire IPO space, we will come to you for a reaction on what are the kind of IPOs are you looking at? Are they promising, or are they leading to a lot of just liquidity extraction from the secondary markets? Also, how should investors be really looking at the opportunities ahead? Meanwhile, viewers, remember that the SEBI chief, Mr. Tuhin Kanta Pandey, has also clarified the regulator's stance on the IPOs. He's actually said that SEBI doesn't set valuations or intervene in the market. He's also pointed out that the regulator's focus is only on ensuring full and robust disclosures. So let's first listen in to what the SEBI chief had to say, and then we'll continue our IPO conversation.
इसके बारे में ही सेबी सोचता है, हम डिटरमिन नहीं करते वैल्यूएशन क्या। ये तो आईज ऑफ द बिहोल्डन है, इन्वेस्टर है। ये स्पेस हम मार्केट में ऐसे इंटरव्यू नहीं कर सकते जिसमें हम पुराने सिस्टम में कंट्रोलर ऑफ कैपिटल इश्यूज में ये डिटरमिन करने लग जाएं कि शेयर की कितनी प्राइस होगी। शेयर की प्राइस मार्केट तय करेगी डिपेंडिंग अपॉन द अपॉर्चुनिटीज, और उसमें सब कुछ फ्री है। तो हमारा सेबी का जो मेन रोल है कि उसमें डिस्क्लोजर जो है वो रोबस्ट होने चाहिए, और हमने तो फॉन्ट साइज तक तय किया हुआ है कि कितने में आप फॉन्ट में बताएं और कंपैरेटिव्स दें। तो इंफॉर्मेशन एंड डिस्क्लोजर पे हमारा जोर है, बाकी की डिटर्मिनेशन मार्केट है। सी कैपिटल मार्केट हैज टू डिटरमिन व्हाट्स द प्राइसेस।
Right, so there you heard it from SEBI chief clarifying that it is for the markets to decide the valuation and the price at which the IPOs are launched. SEBI as a regulator will not intervene into the market to really decide the price, but at the same time they have clearly mentioned to all the companies that are launching IPOs that enough and more information should be available to investors and prospective investors for them to take an informed decision when it comes to participating in the newer companies that are lining up or queuing up to list themselves on the stock exchanges. Mr. Chokkalingam, this actually comes in amidst all this hot debate that's on the D Street on some of the lofty valuations at which the companies are launching their IPOs at. Case in point, the recent one that came in was at Lenskart, and there was so much of debate as to how the valuations were arrived at. How was there such a huge difference in the valuation in just a 3-month time period when the company's promoters themselves bought the shares and when they finally lined up to launch the IPO. Yet at the same time, we are seeing no dearth of liquidity. Investors are latching on to any opportunity that's coming in to participate in the markets. Looking at these new companies that are coming, of course they are new age companies and people do see to do have some or the other understanding and have links with these kind of companies. They use them and their services on a day-to-day basis. But how would you advise investors to assess these newer opportunities that are coming?
Lover. Yeah. So completely I agree with SEBI chairman's statement. It is not the job of the regulators to intervene in the valuation or day-to-day market prices, but they have done ample, they have taken ample initiatives. Like for example, the investment bankers have to disclose the past track record, all that. So I would share only 3 points as far as IPOs are concerned in the interest of the retail investors. One, don't forget to look at the track record of the investment bankers whenever you apply and see in the past, what kind of valuation, those issues have come out and how they rewarded the investors after 6 months or 1 year and including on the listing day gain. And second, the most important point is that there is a structural change. Earlier, a lot of startup companies, once they completely complete the venture capital cycle and start making consistent profit, they used to prefer to go to the primary market. But now today we see a lot of companies which are yet to complete the full cycle of venture capital, they rush to the stock market. What I mean is, even before they before they turn around the businesses consistently, they rush to the market. So that is where the retail investor should be very, very cautious on the valuation. And third, if at all, the peers are available in the listed space, I would suggest, compare the P ratio of a trailing PE, which is easily available on a click of a button, between the primary issue and the secondary issue. If primary issue, has more than 5-10% premium over, the listed peers, where the growth is more or less same year-on-year growth in profit and revenue, then you have to be very, very cautious. And also fourth point is that, a lot of companies are doing offer for sale. This is in contrast to what I used to observe 20 years back. A lot of money used to go for capital expenditures, which used to help the, existing shareholder, which used to help the economy. But now majority of the money is going for offer for sale. So last point, the retail investors before applying for these IPOs, they can also look at this. If it is 100% offer for sale, the valuation also extremely stretched as compared to the peers on the secondary market. One should avoid, if at all you apply very small amount so that, even if you make a big loss on listing, it doesn't pinch your equity asset class. So these are the 4, things which I learned personally, I would like to share with the retail investors.
Fair point. Let's also look at some of the opportunities that are coming in. We've had Groww that's still open. We have Pine Labs. Then, of course, we have Physicswallah that's opening soon as well. Lenskart shut shop with the huge, massive 28 times subscription. Any of the companies that you are looking at promisingly, Mr. Chokkalingam?
See, to be very frank, what has happened, we tend to use all traditional methods of valuation and then we become jokers, because by saying don't apply, then, we we go wrong, and that's okay. When we going wrong is okay, but then people lose opportunity on listing gain. So therefore, I would suggest that if you have a enormous risk appetite and valuation is not exorbitantly premium to listed peer, you apply, take the risk, and possibly on a listing day, if you make money, just exit the stock as long as the valuation comfort is not there, because majority of the stocks on the listing day, they tend to give decent return. So therefore, applying a traditional valuation principle of PE PEG ratio really doesn't help much in this bull market, in primary market. But I would like to add a point that I believe the boom in the primary market is at the fag end of the cycle. So the investors have to be extraordinarily cautious in applying to these public issues from today.
Fair point. So that's the IPO space. Let's also focus back on the secondary market and see where to look for opportunities. Today it's the IT and the auto sector that are still in the driver's seat and are holding up in the market, which is only getting weak. Any suggestion on these two pockets? How are you looking at the IT sector? Of course, as the uncertainty on tariffs still looms large, and auto space that has actually had good news come in by way of GST cards. Festive demand was pretty strong. Many companies have reported good set of sales figures for the month of October, as well as the numbers that are coming in. How are you looking at both these sectors, sir?
Yeah, large IT sector, as I have been consistently saying, that the wealth creation story is over. So short-term investors or speculative investors or traders can look at large IT stocks for possible 5 to 10% gain in the short term, because they are extremely beaten down. So, and also they are quality stocks and have a lot of cash on the book. So 5 to 10% return from stock like Infosys and all, we don't own, but it is quite possible, just to give an example. And the second, for medium to long term investment, one can consider mid-sized IT stocks. They are also beaten down a lot, but I continue to say that what happened from 2014 to 2019, when the large IT stocks were struggling for growth, and there were a lot of acquisition in the small and mid-sized space. I do believe that one or two such consolidation can happen possibly. So therefore, one can look at beaten down high quality small and mid-sized IT stocks for medium to long term investments. As far as auto sector is concerned, I continue to remain bullish. I believe the SUV sales will continue to have a growth momentum. Even the two-wheeler sales will have a growth momentum. In fact, the traditional players are doing much better in the even two-wheeler electric vehicle segment. So the selective players in the automobiles also would do well. And within automobile, if you look at the component, I am extremely bullish on the tire segment, because the replacement demand is very strong after the GST rate cut, and automobile sector also has turned around in terms of the growth. And third, the natural rubber and derivatives of crude oil are the key inputs for tire industry, and crude oil is down 20% from the 52-week high. So therefore, all the derivatives also are becoming cheaper. Even the domestic natural rubber prices have corrected substantially. So therefore, the tire stocks would do very well. So this is my firm view on these two sectors.
Right. Since you mentioned a trigger of falling crude oil prices, the other sector that's clearly benefiting is the paint sector. And performing very well right now is Asian Paints, a stock that has so far been a big laggard in the calendar year 2025. Now, there are several triggers apart from the crude oil prices falling also that have pulled up the stock above 2600. One is, of course, Birla Opus, which has announced in the midweek holiday that its CEO Rakshitha Hargave has quit with immediate effect and has joined Britannia. That's one. We have also seen that Asian Paints will also see increased weightage in MSCI, and that a lot of brokerage houses believe could see inflows of $95 million or so, to the company. Therefore, and so several triggers that are being seen at this point. But let's find out whether the worst is behind. Mr. Chokkalingam, quarter after quarter, we've seen disappointment in Asian Paints, led by increased competition and, of course, demand lackluster that we've seen for the company. But this sudden spike that we have seen, how are you looking at Asian Paints? Are things finally looking up, are turning for the better? Is this the right time to look at Asian Paints?
Sure. In the short term, another 5-10% return also possible in Asian Paint. as we discussed about falling crude prices, because paint industry depends heavily on the derivatives of crude oil. So there will be definitely margin expansion. But what I discussed for IT sector, large IT companies, similar argument is valid for paint sector as well, because two large industrial houses are already got into the paint industry. So according to industry estimates, their incremental capacity addition in the industry will be 50% of the existing capacity. So as a student of economics, my economic sense says that it's going to be very tough for everybody. When the capacity expands by such a big proportion, that too with the support of large industrial houses, it is going to be very tough competitive game in this monopolistic industry, which has got already more than 6-7 players. So short-term tactical return is possible, but for creating a consistent wealth, I would not suggest. And you mentioned about Britannia. I believe Britannia is a unique player within the FMCG. It's as it is heavily focused on biscuit. It uses two core inputs, one wheat, other sugar. Interestingly, the international sugar prices have crashed on year-on-year basis, and domestic market also they are weakened. The wheat price also started weakening, and wheat sowing area and harvest are expected to be very robust, and therefore wheat prices are going to correct significantly in the domestic market as well. It started happening. That's why there was a margin expansion in Q2, and I believe there would be margin expansion in Q3, Q4 as well for Britannia on a year-on-year basis. So within the FMCG space, entire FMCG space, I believe Britannia has become quite attractive. And just as a disclosure, none of the stocks which I discussed here I hold personally or directly or indirectly.
Okay, fair point. Let's also discuss some of the other aspects. PSU banks is something that I wanted to discuss with you, Mr. Chokkalingam. How have you assessed the earnings that have come in thus far? SBI has also recently reported its numbers. We've also seen some brokerage houses upgrading the stock, the rating as well as their target prices as well. And wanted to understand whether a fresh wave is about to start or will it still take some time as well. When we are talking about SBI, the other key trigger is also that SBI is also looking at divesting 6.3% stake in the upcoming mutual funds IPO that could be coming in 2026 for the company as well. SBI Funds Management, remember, of course, is the largest one that we are looking at, and that could also be looking to list soon. How are you looking at the PSU banking space and SBI?
Yeah, so SBI we have initiated and it has done very well, and at current price it is fairly valued, and at best it can hit 1,000 rupees, but it might struggle to hit that because the valuations are slightly good. And also the core business has not done well in Q2. It is because of the extraordinary income it has done very well on net profit growth front. I am extremely bullish on otherwise on PSU banks, public sector banks. I believe the mid-sized PSU banks will do extremely well. There is a structural change. The structural change is that in the last 5 years, phenomenal improvement in the net NPA by these PSU banks. Before 5 to 6 years, they used to have a net NPA even up to 7-8%. Now, most of these PSU banks have reduced the net NPA to less than 1%. They hover around on an average 0.5, 0.6%. Secondly, what used to be a liability in terms of vast network in the days of digital banking, now the same thing has become a great saver for PSU banks, that is branch network, in terms of retaining the CASA deposit ratio. And some of the PSU banks have beaten even the private banks in terms of share of low cost deposits, namely CASA deposits in the total deposits. That is helping them a lot on the margin basis because the interest cost on the CASA deposit is very low. And because of the branch network, vast network, they are able to retain the CASA deposit and they are able to even grow when some of the large private banks are struggling. Third, the consolidation has done a wonderful job in improving, the earnings as well as the valuation multiple. And once again, there are talks of possible consolidation. So I have an interesting idea in my mind. If you want to take any bank global, instead of any city name or state name, it is preferred to have a suffix or prefix India name. So I believe, it's just a common sense approach. I may be wrong because the last consolidation, also if you see all, banks which are merged were Allahabad Bank, Vijaya Bank, Syndicate Bank, Bank of Travancore, Mysore Bank, State Bank of Mysore, State Bank of Travancore, State Bank of Hyderabad, State Bank of Jaipur and Bikaner. So I believe, tactically there is a possibility of, the PSU banks which have India tag and also trades around one time price to adjusted book value. And also net NPA less than 1% or even less than 0.67%. I would favor them. I think that particular segment offers a lot of opportunity. Even if they don't become a core bank in the amalgamation, the individual valuations are appealing. That would be an opportunity. So I remain very, very optimistic on selective PSU banks.
Fair point. Well, okay. Thank you so much then, Mr. Chokkalingam, for being with us on the program and of course for detailing for all our viewers how to look at the current earnings season, the IPO space and where can one really look for opportunities in the current market as well. Always appreciate your time. Thank you. And of course, from the entire team of Business Today Television, we wish you a belated happy birthday as well, sir. Thank you so much.
Thank you very much. So kind of you. Thank you very much.
Thank you so much for being with us. All right, viewers, let's quickly look at how the markets are closing in trade today. We have slipped to the day's low point, but managed to just probably defend that 25,500 mark. 83 points lower in trade. That's almost 0.5% almost for Nifty Bank as well. 265 points lost there. So the Nifty Bank has had a bigger blow. By the end of the day, you only have IT and autos that have managed just light bit of gains, even though both these sectors have also slipped. Auto is just nearing turning red as well. So again on the slipping zone. But metal stocks, real estate, broader markets, mid and small caps, PSU banks, infra and financial services all lower in trade. This is despite the fact that India VIX, the fear gauge index, that's also lower in trade by almost 4.5%. So 12 odd levels is what you're still looking at on India VIX. Despite the fact that India VIX and the volatility is low, markets have completely lacked the strength. Top movers, Asian Paints, Reliance, UltraTech, Mahindra & Mahindra and Wipro. But on the lower end, you have Grasim, you have Hindalco, you have Adani Enterprises, Power Grid and Eternal as the top stocks that have lost ground. But there have been some stupendous winners like Reddington, for instance, from the Nifty 500 basket. 14.7% higher is the top winner there. Smart moves being seen. You also have CCL Products that's up by 10 odd percent, and this is after the earnings. Bajaj Holdings up by around 8%. Also have International Gemological Institute again higher. Astral, Gujarat P-Power, Asian Paints. These are all the big winners that we've had today despite a weak trade. Alright viewers, we'll wrap it up on that note, but do stay tuned with us on Business Today Television even beyond the market hours. The coverage from the world of business and finance continues, and of course the market coverage begins tomorrow morning at 9 a.m.